Welcome back to the deep dive. Today we're running the Talk Tickers playbook. We're focusing on just one company's earnings call transcript. Palmer Square Capital BDC, that's ticker PSBD, and we're digging into their Q3 2025 results.
And this was a really critical call. It happened intraday, November 5th, and you have to remember the context. The whole BDC and private credit space has been facing some serious headwinds.
Right. People are worried. They're worried about defaults. They're worried about valuations. You hear it everywhere.
Precisely. And for anyone who's maybe a little new to this space, a BDC, well, think of it like a publicly traded private equity fund. It lends money to, middle market companies.
And passes the profits on as dividends. That's the main appeal.
Exactly. So our mission today is pretty straightforward. We're going deep into PSBD's numbers. Management is telling a story of rock-solid credit quality and, crucially, that their stock is undervalued.
And we need to see if that story holds up against what the market is telling us, because the market is definitely skeptical right now. This is all about separating the signal from the noise.
Okay, so let's jump right into the headline financials for the quarter. They actually delivered a modest beat on both the top and bottom lines.
But it's a very mixed picture when you look closer.
It is. Let's start with the most important number for any BDC investor. Net investment income, or NII.
Right. This is the cash flow that pays a dividend. It came in at 43 cents per share.
Which beat the consensus estimate of 41 cents. So that's almost a 5% beat. Good news.
But here's the catch, and we really need to zoom in on this. The NII was 48 cents in the same quarter last year.
That's the key. So yes, they beat the street's lowered expectations, but they still saw a pretty significant drop year over year.
And that really gets to the core of it, right? Why were expectations so low to begin with?
Well, because the market was pricing in all those headwinds we talked about. Higher funding costs, maybe slowing borrower growth, all of it. The fact they hit 43 cents suggests they managed things a bit better than analysts feared.
Now, what management really hammered home on the call was the dividend coverage.
Oh, absolutely.
Yeah.
This is their main point. That 43 cents of NII easily, comfortably covered the total dividend of 42 cents for the quarter.
And that 42 cents includes both the base dividend and the supplemental.
Right. The 36-cent base and the 6-cent supplemental.
Yeah.
For them, covering that dividend is goal number one, and in a nervous market, showing that coverage is a huge green flag.
So the income side feels stable, at least for now. But
Right.
then you look at the other side of the coin, the number that keeps BDC investors up at night.
Net asset value, the NAV.
And it continued its slide. It fell to $15.39 per share. That's down from $15.68 just last quarter.
And that's a 1.9% drop in the value of their underlying assets in just 3 months. When your NAV is consistently falling, it means one of two things.
Either the loans are being marked down in value or they're realizing actual losses.
Exactly. And that, I think, more than anything else, explains why the stock is trading where it is.
The market reaction seems to back that up. The stock closed up a little bit on the day, but the volume was just dead.
Super low volume. It was a very measured response.
Yeah.
The market basically said, okay, the dividend looks safe for now.
But we're still really worried about the asset quality.
Right. Show us the assets aren't rotting underneath. Which brings us to the next big topic, portfolio quality. This is the absolute heart of the bull case for PSBD.
And their whole argument is that their portfolio is just built different, that it's better structured than some of the other BDCs that are making scary headlines.
And they have some compelling numbers to back that up. Let's slow down and look at these. First, non-accruals.
These are the loans where the borrower has stopped paying interest?
Right. And PSBD's non-accruals are at just 0.40% of the total portfolio at fair value.
That's almost nothing.
It's exceptionally low. To give you some context, in a stressed environment like this, it's not uncommon to see non-accruals run between 1% and 3%. So 0.4 is nearly flawless.
If credit risk is the big boogeyman, then PSBD seems uniquely insulated based on that number.
And it's not just that. Look at their PIK income. Payment in kind.
Which is basically when a borrower pays you with more debt instead of cash. A big red flag for cash flow problems.
A huge red flag. And their PIK income is only 1.14% of their total investment income. Again, extraordinarily low. Their borrowers are paying in cash.
Okay, but let me play devil's advocate here for a second. If the credit quality is that good, Why is the NAV still falling?
That's the million-dollar question.
Are they just being too optimistic on the valuation marks for loans that are struggling but not technically in default yet? That drop from 1568 to 1539 has to come from somewhere.
It does, and that's the essential conflict here. Management's answer to that was to point to signs that things are actually getting better for their borrowers.
You're talking about the interest coverage ratio.
Exactly. They reported that the weighted average interest coverage ratio for their borrowers rose to a very healthy 2.5 times. That's up from 2.1 times just last quarter.
So the average company they lend to has operating cash flow 2.5 times bigger than its interest payments.
Correct. And that jump is a massive vote of confidence. It means their borrowers are growing earnings or adapting to the higher rates. If that keeps up, it should stop the NAV erosion.
Let's shift to deployment. How are they putting money to work? They were active, but maybe not in the way you'd think.
Right. They deployed about $139 million into 28 new deals. But critically, they got back about $156 million from repayments and sales.
So the portfolio actually shrank a little bit.
It did. And that confirms what management was saying on the call. They are prioritizing discipline over growth. They're not just trying to replace every dollar that comes back.
They're only putting capital out when they find deals that meet their, very specific, very safe criteria.
And that thesis is all about safety and security. 95% of the portfolio is senior secured. 86% is first lien.
Meaning they're first in line to get paid back if something goes wrong.
That's fundamental to their whole model. And they're using what they call their dual engine model to source these deals. New private credit loans made up about 21% of their new investments, and they got them at a great spread, about 536 basis points over the reference rate.
So they're finding pockets of value, and then they're putting their money where their mouth is with buybacks.
A very important signal. The board approved another $5 million for open market share repurchases.
Now, when your stock is trading at a 23% discount to NAV, buying back shares is just it's pure math. You're buying $1 of assets for 77 cents.
It's immediately accretive to the shareholders who are left.
But I have to ask, is $5 million really enough to move the needle? Or is this more of a signaling exercise?
It's definitely signaling. But in this market, that signal is crucial. It's management telling the market, we believe our 1539 NAV is real, and we're willing to bet on it.
They also talked a lot about transparency.
Yes, and this is a unique angle for them. They're the only public BDC that provides a monthly NAV disclosure.
Which is a huge deal. It means they can't hide from bad news for 3 months. It forces accountability.
Totally. It addresses that skepticism head on. And they're also managing their own liabilities, not just their assets. They refinanced a big credit facility, pushing the maturity out to 2030, and actually lowering their interest rate on it.
Okay, so if we put all of this together, you have these strong internal metrics. But the stock has just been hammered.
Completely disconnected.
Yeah.
Over the last year, PSBD is down over 24%. The S&P 500 is up over 17%. Even the BDC sector ETF, BIZD, was basically flat.
So why the massive underperformance?
It's that big BDC meltdown of 2025 narrative. It's a sentiment story. You had high-profile defaults in the sector like Tricolor and big firms like JP Morgan and UBS issuing downgrades. The market just decided to sell everything related to private credit.
And PSBD wasn't totally immune. They did have to add a company, First Brands, to their non-accrual list this quarter. So how did management fight back against that fear?
Chris Long was very forceful on this point. He argued that these credit issues, including their own with First Brands, are idiosyncratic, not systemic.
Meaning it's a company-specific problem, not a sign that the whole economy is collapsing.
Exactly. It's a bad balance sheet or poor management at one company, not a widespread credit event. And then he pointed right back to their 2.5 times interest coverage and the 0.4% non-accruals as the proof that their portfolio is different.
Don't judge us by our neighbors.
That's the argument. And Angie Long added some color on the macro trends. She said they're seeing a gradual improvement in M&A activity. She even cited that huge $55 billion take private of Electronic Arts as a sign that capital is starting to loosen up for good deals.
But they also had to talk about the Fed. We got 2 rate cuts, 25 basis points each, right before the call.
And that's a double-edged sword. Lower rates help borrowers, and they can support asset values, but management was very clear. Declining rates will eventually squeeze their asset yields.
Right, because most of their loans are floating rate. That's the long-term risk to keeping that 43-cent NII.
So their plan is simple. They said they will not chase growth, just to keep yields up. They're going to stay disciplined and rotate capital into higher spread private credit deals when it makes sense without sacrificing quality.
They seem cautiously optimistic.
That's the perfect phrase for it. They think their portfolio is compelling, especially at this discount. But they know investors are still waiting for proof that they can withstand a slowdown without more NAV erosion. It's a total show-me story.
Okay, let's switch gears. It's time for the segment where we put on our aggressive hedge fund hat and pitch a trade idea.
And we have to say it every time.
Yeah.
This is not financial advice. We're just connecting the dots from the call into an outrageous but plausible trade.
The story here is simple. PSBD has great fundamentals and a terrible chart.
And management is literally buying their own stock at a 23% discount. They're buying $1 for 77 cents. We should probably pay attention when they do that.
So the trade idea is long PSBD and short the broader BDC sector using the ETF BIZD.
The thesis is all about isolating what makes PSBD unique. We're making two bets. First, that their credit quality story is real.
That the 0.4% non-accruals and rising interest coverage mean that $15.39 NAV is legit.
And that the market is just wildly mispricing the risk. And second, we're betting that the buyback and the solid dividend coverage will start to close that massive discount to NAV.
And the hedge is what makes it so interesting. By shorting the BIZD ETF, you protect yourself against the big, scary macro risk.
Right. If the whole big BDC meltdown story gets worse and the entire sector sells off, your short position in BIZD should cushion the blow.
So the trade is designed to let PSBD's specific strengths, that verifiable credit quality and the dividend coverage drive performance, even if the sector stays ugly. You're basically leveraging management's conviction against the market's panic.
It's a classic bear trade.
So wrapping this up, what does this all mean for you? Well, PSBD delivered a clean quarter. They did what they said they were going to do.
They covered the dividend, they reaffirmed their commitment to super safe senior secured credit, and they're returning capital to shareholders through buybacks. They've met the moment with strong metrics and a ton of transparency.
But that core conflict is still there. It's management's measured, bullish view, which is backed by their numbers, fighting against the market's cautious negative posture, which is driven by sector-wide fear and that falling NAV.
The market is just waiting for more proof. They want to see that PSBD's quality is truly durable enough to weather a continued slowdown.
And here's a final provocative thought for you to take away and explore. Given that the Fed has started cutting rates, and 98% of PSBD's loans are float rates, their asset yields are going to compress as rates fall further.
The big question for next year is this. How quickly can they rotate their capital out of those loans and into higher spread private credit deals to protect that 43-cent NII level?
Because defending that yield will be the single most important factor for this stock. Thank you for diving deep with us.